In this episode, I'm talking about 10 ways you can get access to your retirement funds before age 59 and a half, penalty free. So make sure you watch the whole video to learn all the ways that you could possibly access these funds. Welcome back. This is episode 240. A few weeks back, I talked about new rule, I should say, pertaining to early access to your 401k plan for emergencies. And this week, I want to talk about 10 of the other most popular ways that you can get early access to your 401k or IRA penalty-free. So be sure to listen to the end where I mention one of the best penalty-free distribution options that is only available inside of qualified plans. And in case you're not familiar, a qualified plan is what a 401k plan is. Now, if you're like most people, you probably set some goals for 2025. Hopefully you haven't abandoned those goals yet. And if one of your goals is to develop a plan for retirement, then you should consider hiring a financial advisor to help you do that. Now, not just any financial advisor, but a fee-only fiduciary advisor. This is someone who will always put your interests first. Now, I've written a book to show you exactly how to hire the right financial advisor for you. In this book, I walk you through how to find, hire, and establish a trusted partnership with a fee-only financial advisor. I also walk you through how to get the most out of this relationship and what pitfalls to look out for. Now, I'm currently giving away a full, free electronic version of my new book. You just have to head over to retirewithryan.com to download your free copy. Again, just head over to retirewithryan.com and you can download a free copy of the book. Just put in your name and email address and you'll receive it. So I mentioned earlier that I want to talk in this episode about 10 different ways you can get penalty-free access to your retirement funds. And normally, in case you're not familiar, you have to wait until age 59 and a half. That is the general rule to be able to access any of your retirement accounts without penalty. If you want to take those funds out prior to age 59 and a half, then penalties can apply. And that penalty is currently a 10% penalty that sits on top of any other income tax that you would owe, assuming we're talking all about pre-tax monies. That means non-Roth accounts. That's what we're talking about. So I want to go through these 10 different examples, and as I mentioned, wrap up with probably one of the best ones that only applies to qualified plans. So way number one to get penalty-free money from your retirement accounts is to pay for unreimbursed medical expenses. So if you have unreimbursed medical bills that exceed 7.5% of your adjusted gross income, you're able to withdraw funds from either your IRA or 401k to cover those expenses. And generally, these withdrawals must be made in the same year that the medical bill was incurred. So you do need to submit the medical bill along with the form to apply for this waiver. And it's also worth noting that normally to be able to deduct medical expenses on your taxes, they have to exceed 10% of your adjusted gross income. That's not the case. You can actually get this exemption without having to meet that threshold. And most medical bills qualify because this is a necessary medical expense, which according to the IRS, most are. Way number two is due to disability. You can take penalty-free withdrawals from an IRA or 401k in the event of disability. And the IRS has specific guidelines as far as what qualifies for total or permanent disability to avoid this 10% penalty for early withdrawals. But this is a way that you can get access to retirement funds if you're not 59 and a half. And this applies to both retirement plans, or I should say, I'll just say 401ks, as we're talking about qualified plans, that's what that will mean, and IRAs. So way number three is for health insurance premiums. Penalty-free withdrawals are permissible from IRAs when used to pay for health insurance premiums. However, you must be unemployed for 12 consecutive weeks to qualify for this exemption to the 10% penalty. And it's suggested that you open a separate bank account that's used only to receive these transfers from the IRA and used exclusively to pay for these insurance premiums. That way you have good records and a good paper trail in the event of an audit. Now, this is not available for 401k plans. So this exemption does not apply for 401k plans. So if it was a 401k and you need to take money out to pay for those medical expenses, then you would have to pay the 10% penalty. Way number 4 is not that pleasant, but it is due to death. And this doesn't benefit you, but it could benefit you if you inherit a retirement plan from a spouse, from a family member, from a parent. If you're not currently 59 and a half, that 10% penalty is waived for any distributions that you take from the account. However, there are certain requirements that you have to follow and certain paperwork you have to submit to be able to take these distributions. I've talked about this in past episodes about inherited retirement accounts, so definitely check that out. But this is a way to waive the 10% penalty. Option number 5 is if you're in debt to the IRS. So currently, if you're in debt to the IRS, if you're in arrears to the IRS, they might place a levy against your IRA. And if you want to get ahead of that, you could actually take money out of your IRA, out of your 401k to pay back the IRS for any debt that is owed. And they are waiving the 10% penalty on any of these distributions. Way number 6 is for first-time home buyers. You're able to take money out of your IRA up to $10,000 over your lifetime to pay for your first-time home purchase. And this is a lifetime option. So once you use it, you lose it. And if you don't use it, you also lose it. And you can take this out over different points. So you could take one large withdrawal, you could take a couple for $5,000, you could take 4 of them, and it's up to you to decide if you want to take this out, but it does avoid the 10% penalty. And unfortunately, this only applies to IRAs. It does not apply to 401ks. Option number 7 is for higher education expenses. So with an IRA, this is another one that only applies to IRAs. You could take money out of an IRA to use for qualified expenses, and these are any withdrawals that you're taking out of the IRA to pay for schooling costs, to pay for tuition, fees, any related expenses for an eligible student. And as long as they're enrolled or intended at that institution, you may pay for these expenses. And there are, however, a number of expenses that don't qualify. So people are surprised to find out that room and board doesn't qualify, insurance doesn't qualify, medical expenses don't qualify, transportation expenses. So these things do not qualify, but there is a whole list of expenses that qualify, and this applies to an IRA only. It doesn't apply to a 401k, unfortunately. Option number 8 is if you take out distributions that are substantial in equal payments. So this would be most commonly used for someone who retires early and wants access to their retirement funds before age 59 and a half. And in this case, you'd have to agree to take out money from your retirement account for 5 years or until you turn 59 and a half, whichever is greater. So you set up the certain amount that you're taking, and you have to keep taking that out. You have really a limited ability to modify this, and you really have to be careful with this, because if, let's say, you retire at 54 and you decide you want to do this, well, you'd have to take out the money for roughly 6 years, meaning you're agreeing to take out, let's just say, $50,000 a year from your IRA or 401k for 6 years. And if 2 years later you decide you don't want to do this any longer because you decided you wanted to go back to work, or your need for this income change, you really don't have the ability to shut that down. So the IRS is allowing for the 10% penalty to be waived because you're agreeing to take these payments out for a significant period of time, which is giving them tax revenue, but you really don't have the ability to shut this down. So this one you have to be really careful about if you do set this up, but it is a good way that you could have the 10% penalty waived. Reason number 9 is a sad one, but if you are terminally ill, you can take money out of your 401k or qualified plan without a 10% penalty. Unfortunately, this doesn't apply to an IRA. And there is a process with this. You do have to get certification from a physician that you are terminally ill, and then you can take out money from your 401k without a 10% penalty. And the last reason, which is what I mentioned at the beginning, probably one of the best ways that you can take money out from a qualified plan that allows you to waive their 10% penalty and gives you flexibility as compared to the Section 72T, which was that substantial and equal payment requirement. So the IRS says that if you're 55 years of age and you leave your job or lose your job, you can actually take money out of your qualified plan before 59 and a half and avoid the 10% penalty. Now, again, this is if you're going to be 55 during the calendar year that you lose your job or leave your job, then you have this provision. So let's just say you leave your job at 54 or lose your job at 54 and you won't be 55 until the next calendar year, then unfortunately this wouldn't apply to you. But from 55 to 59 and a half, this is a big benefit to people because you can get access to your retirement funds and not pay the 10% penalty. However, this is only applying to a qualified plan, so a 401k or other qualified plans. And this is one of the reasons why you might not want to immediately roll over your entire 401k upon leaving that company if you're separating from that company between 55 and 59 and a half. So let's just say you've got $1 million 401k, you worked for Raytheon, and you're leaving your job at 55, but you're fed up with Raytheon, you don't want your money in there anymore, and you want to roll the whole thing over to your IRA at Charles Schwab. Well, before you do that, you might want to think about what your income needs might be between now until 59 and a half, and maybe leave some of the money behind in your 401k in case you need access to it. Maybe you left behind a couple $100,000, so that would cover you for the next 4 years roughly, and you could take money out of that 401k without the 10% penalty if you need it. If you don't, at the end of the 59 and a half point, or where you hit 59 and a half, you could roll that money back over or out to your IRA wherever you have your money. So it is a nice benefit that applies to most 401k plans. Most qualified plans have this provision. I had a video about the resignation offer that's been offered by the federal government, and this applies to the thrift savings plan. So any listeners that have money in the thrift savings plan, before you roll that all over, if you're between 55 and 59 and a half, you might want to leave some in there in case you need early access to it. Additionally, certain public safety employees, this actually applies at age 50. I believe like air traffic controllers, there's a list the IRS has of people that this applies to where you can actually get it out at age 50. So there could be some qualified plans that have even greater benefit to let you get the money out at age 50 versus age 55. And as I said before, if you want to just leave some money in the plan and then roll the remainder out, you can do that. You can leave all the money in the plan. It really just depends on what's going to be best for you. So again, before you go and roll that money over to an IRA, you want to check out whether this age 55 separation of service applies to you, or age 50 if you happen to be the select few that can do that from age 50. So again, there's a number of ways that you can get money out of your qualified plans without a 10% penalty, and you want to check those out anytime you're considering making a distribution. Make sure that you're following the procedures and you have the right documentation so that when it comes time to file your taxes, you don't get surprised and you don't get necessarily hit with that 10% penalty. But remember, if we're talking about pre-tax money, that money is still going to be taxable to you, but it would be nice to avoid the 10% penalty. So I hope you found this episode helpful. If you haven't subscribed, please do so. And if you have a listener question that you want to have considered for a future episode, head over to retirewithryan.com and click on Ask a Question. And while you're there, consider downloading a free copy of my book. Have a great week, and I look forward to talking to you next Tuesday. Take care.